Okay. Good morning. This is Vince Lanci with the Gold Fix. Was at 7:30. Now moved to 8 o'clock. Um, we had a very interesting Friday. We're going to go over that. We're going to go over the fact that the market is lower presently, and we'll go over what to look for the rest of the day and for the week. Today, gold is lower, as you can see from the daily chart I have up there. Futures trading 1197.40, and that is significantly lower than Friday's close. The dollar is stronger. Stocks are off globally, and the bond market is officially closed for Columbus Day. A couple things to keep in mind, mantras, if you will. Number one, gold is not a hedge for a stock market correction. It is a hedge for a prolonged stock bear market. So what we had on Friday and continuing it today is a stock market correction. Number two, China is de facto pegging its currency, the yuan, to gold, which plays into what we're about to talk about. And QT, which we're in the middle of, is bearish for gold now and much more bullish later. Later, because QT will just bring about its own demise, and after a crash, there'll be a QE again. Okay, so let's go through today's action so far. Uh, China came back online last night, and in doing so, uh, I think expectations were that gold would be lower when China came back online, and they did. So a lot of people that are lifelong gold bugs might be wondering why this is. Why did gold rally during Golden Week and then sell off after it? And if you want to look at it just from with those two parameters, you could easily come up with a conclusion that China was buying quietly through London, and now that Golden Week is over, they're done their buying. I don't buy into that, but I do think China is a factor. Uh, what we have with gold is you have gold is increasingly gold is increasingly correlated with the dollar yuan pairing, and historically it has been tied to the dollar yen and the dollar euro in combination, but the yen has been over the years more a tighter correlation. But what's happening now is China is as it attempts to de-dollarize, uh, they need to provide a stable transition from the dollar as its uh, reference point or peg. It used to be a peg uh, to its own product. So by that I mean, if China has ambitions of being a global currency, they need to stand on their own. Before they can stand on their own, they have to get off the dollar standard, which they did, and they have to tie themselves to something that is more stable in value and that they have bought a lot of, and that would be gold. So, what you have now is you have China backing uh, an oil futures contract in yuan and gold. You have China accumulating gold, and you have Russia and the Saudi Arabians selling oil to China in uh, dollars for yuan backed with gold, for yuan with convertibility into gold. So, if you believe in that backdrop, as I do, um, the tie between gold and the U.S. dollar yuan pairing makes more sense, and it's been more exacerbated. It's been exacerbated by the trade wars. So every time we levy tariffs or threaten to levy tariffs, to simplify it, the Chinese levy tariffs and or debase their own currency, weakening it against the dollar in order to offset their exports, the tariffs. Bringing it back to gold itself, this is bearish for gold. So, if you want to look at it in very simplistic, realistic terms, if you believe the Chinese are buyers of gold, well, as their currency weakens, they can't buy as much of it. So, if the yuan weakens, meaning goes higher, goes from 6 to 6.5 to 7.0 per dollar, then gold will come off. And I suspect that will continue for years. even after the trade wars are solved, if they ever are solved. So right now we're trading 11.95, 60, 70. Last week, and I want to go back to last week Friday because it's actually important. There was this chart I had up last week, and this chart was a discussion on how last week after 11 o'clock, gold tended to sell off, and we thought that was because once London closed, whoever the buyer was is no longer there. But in this corner are the numbers that I thought were the most important, and I'm going to reiterate them. Uh, Above 1208, 1212, 1213. But if you look where we are now, we're below 1201. And I don't have 1197 as a number, but it seemed to have been a little bit of support for a while. Below 1201, I think, is a really large, um, bigger than most. I think it's a sign that the bear move is back in play. So I don't think 1194, 93 are going to hold very well. I think 1189 is important. 1179 not that important. And then of course you can look at the low of 1167 that the opportunistic trader, specifically Larry Benedict, called uh, and uh, put out in a tweet the night that it made that low. So these numbers are still the most important numbers today. So let's go back to today's chart, and you can see where they come in. All right, so this is a daily. And we're going to go to the hourly. All right, on the hourly, I drew two white trend lines today. Now, I drew them after the fact, obviously. So I'm not saying that there's any predictive value here, but what I am noticing as we're making new lows is that the first line, which is not violated by anything, that would be the one starting there. Well, I just moved it. Well, you get my point. The first line, the first line comes in starting at the lower line, the lower white line, comes in the 1205 area today, 1204, 1205 area. And the second line comes in at the 1201 area. Now, the second line I like better because it actually has been penetrated and then uh, 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 bounced through. All I'm saying today is that gold is not, I would be selling rallies, not buying dips, unless you're already short. And I think the market, technically, for technical reasons, which I'm not, obviously that's not my strength, but for a person who watches the market and macro drivers behind the market, gold is not a buy. Um, uh, I would look to buy it in the 1189, 1190 area if it gets there and see how it holds. You have some major trend lines that might be holding there, and I would be careful. Uh, I think it's important to talk about what happened on Friday because today is a continuation of that. So let's go to, well, we're still on the chart. So why don't we stay with this chart? So on the hourly chart on Friday, gold started out stronger, right? You see it's rallying there. The jobs number came out at 8 o'clock, between 8:30, I should say, and gold sold off a little bit. Now, the stock market, and this is important because this is what's driving us right now. The stock market did little at first, and then it proceeded to sell off with bonds and the dollar. And after that, actually, gold sold off right after the number. After the dollar started to sell off, gold began to rally a little bit, but it never got to where it was. So you have the dollar flat in the morning and gold higher, and then the dollar sells off, and then the dollar strengthens a little bit, and gold goes down in a very whippy fashion. There's red candles, and then as the dollar got crushed for a couple hours, down 40 points, according to the DXY, gold never made new highs. That's a bad sign. Now, if you're looking just at gold as a technician, that should make you bearish. I wasn't looking at it that way. I was looking at it more like this. China comes back online. Uh, it may be a non-event for every other market. It may be a continuation, but it will be a reversal for gold. and we said as much. Well, over the weekend we said as much. So what we have now is we have on a market basis, right? And this is what's important to understand. On Friday, the jobs number came out disappointing. Stocks initially did very little. Then stocks started to sell off. Bonds started to sell off. Bond yields started to go up again. And a little bit of a snowball effect began. The dollar initially sold off and everything started falling out of bed. Gold held on Friday. This is what gold did during that time frame. Uh, Stocks continued to sell off, and then the dollar started to firm up. Now, I think what we're looking at here, without getting uh, uh, too deep into the fundamentals or cash flows of the situation, are this: whatever happens. In fact, we have an article on that on the opportunistic trader right now, and see if I can get that up. Here we go. Okay, so this is about the stock market, but I want you to think about it for gold purposes. Friday's disappointing jobs number for September should have been an excuse to push yields lower. It did not. Uh, Traders finally took note of the oil price increase, and oil price increases are strongly correlated with 10-year bonds of late. The jobs number should have been, and this is the gold point, should have been a reason to sell the dollar. And although it did back off a bit, it did not go out weak. Did not go out weak because of quantitative tightening. As the government issues more debt or doesn't re-up debt that rolls off that it has bought, it is increasing our deficit or increasing the monetizing our debt, so to speak. Simultaneously, in order to mitigate that, they're draining liquidity of dollars. So Friday's close, uh, while it was bad for U.S. people, was actually worse for emerging markets. And here's what I'm getting at. Okay, this is dollar liquidity in the U.S. So excess liquidity versus the S&P. Right, why does this matter to gold? All right. So as the as liquidity dries up, the liquidity is in the black, the black line, and the stock market, the SPY specifically, is the light blue. Liquidity will dry up, and then the stock market will sell off. Now, let's apply this to the world. We have a lot further to fall than the rest of the world does, but I don't think we're going to fall as much as the rest of the world will, because I think the rest of the world is now putting their money in U.S. stocks, rotating out of their own country stocks. Uh, what this means for gold? It means that central bankers in countries that are indebted in dollars are going to have to need more and more dollars, and they will sell more and more gold or anything that's not tied down to get those dollars. So I think you're seeing foreigners sell U.S. bonds. I think you're seeing foreigners selling gold, and I think everyone needs dollars. So just the world needs dollars as the Fed is draining the dollars out of the market, even though it's issuing more debt. Or the effect is issuing more debt. So today, I think is already baked into the market. China, China and European woes, I guess is the word you would use. Uh, they're weighing on stocks globally. The Shanghai and Shang Seng composites are down almost 4%. The yuan slid nearly 0.8%. So why don't we go back to that so we can talk about that for a second? All right. If you notice, you have the offshore U.S. dollar CNH and U.S. dollar CNY. That's the onshore or the renminbi. They're close now, but basically this has been free floating while while the while China was closed for business. But today, uh, the official so there's your scale thing. This is them being closed, and now this is them actually letting the yuan float freely against how it's being priced offshore, which is a little bit surprising. I expected some capital controls to come in. They did lower their requirements for banks to have reserves, but it didn't really give a lot of help. Um, uh, Chinese return could have been dramatic. They cut required reserves, as I said. Their PMI came in a little bit stronger, and their other issues were their other positives were not able to stem the tide. The dollar is now above 692 yuan, and there is speculation that, as stated by J.P. Morgan, I think, and others, that the line in the sand is 7.0, and I don't think it's significant as it was thought before. But China's economic deterioration is a bad thing for gold, and by that I mean China's reserves keep getting depleted. They could actually turn into sellers of gold. And if I'm even thinking about China as a seller of gold, then you have to think other countries are already selling. Let's look at the other metals. Gold is uh, down 1%. That's cash silver. Let's go to futures. All right, and you set the scale there. Okay. Silver, silver gold ratio is probably going to suffer again. I think silver will exacerbate its moves to the downside compared to gold, but there's no clear trend higher anymore, as there had been for since, say, the 28th through the 3rd. Yeah, it looks like we're in another wave lower. I think the important thing for today is just to discuss uh, the numbers and uh, and keep these in mind. All right. Uh, if this is a Michael Moore's technical analysis, which corroborates my volatility analysis, which gave us a sell signal on Friday. I did not participate in. Uh, all right, if we break above 1208.5, he says right here, right there. If we break above 1208.5, starting at 9 a.m. and back below, look for profit taking to come in. All right, so we're nowhere near that anymore. All right, he's saying buy into 1193, 1187 area. Um, uh, 1190 30, I should say, 1187. Uh, those are his numbers. I'm sure they're good numbers. I have 1193 as a number. It really doesn't matter, not to belittle technicians, but it really doesn't matter what number you have, so long as you stick with it and you're disciplined with it. Um, I think the market is just going to track the dollar today, the DXY, and more specifically the yuan. Uh, there's no real good news about this right now, but if stocks go lower quickly, gold will go lower too, because the dollar will firm up. Everybody will be flight to safety. Does not does not mean flight to quality. The dollar's liquidity trumps uh, uh, gold's store of value, and by that I mean you just can't get out of gold fast enough if you want to put it into something else. So today is a day of uh, cautiousness. I think today, the average daily range last week was $10, and it says 105.8. It's basically $10.58. I think you might actually have a bigger range than that today already. I think we're going to have a range expansion, and I'd be on the alert for uh, anything below 1189. I would be very careful, looking for uh, no, below 1189. See, 1193 is holding currently, but below 1189, I think we're talking about 1167 is definitely on the plate. 1179 is a big deal, but really not much positive to say, except that we saw this coming. We saw this coming because uh, gold's not a safety for stocks that are in a swoon, and China was coming back online, and we knew that their currency was going to be weaker. So if you had a chance to sell it on the open Sunday night, good luck to you. Uh, and good for you. Otherwise, I don't think you're going to see anything but uh, bounces that are leaned into. Let's look at the 4 hour, and I'm going to uh, see if I can do this. All right, 4 hour offers no parent help. So I don't really see much in between here and 11. Actually, on this, it's 1185, but 1187 is my number. So we're below 1193 now. I think everyone should get to trading if you're not already. I think 1189 is our next stop. And from there, I do not, we're going to get a volatility expansion signal on a weekly basis. And, you know, the only thing I'll say that's going to make anyone who's bullish feel good is, 2T is bearish for gold. And I think there is there are multiple either countries or entities selling gold above the market, and that's why you see these long wicks above on hourlies and daily charts. Have a good day. Uh, I'd be looking to buy vol if the market. Be looking to buy vol now um, if the markets were open and looking to trade some gamma aggressively, not aggressively, meaning loosely around the 1189 area, letting it run if we go below and letting it run if we go back above. Have a great day. It's 8:22, and I'm Vince Lanci, and I will be off tomorrow. Personal obligations, and hope to see you. Hope to hear you all on Wednesday. And thanks to Greg and Joe and Tom for joining us. New listeners. Have a great day, guys.